It's Saturday, April 27th, 2019. I'm Justin Castelli, and this is your All About Your Benjamins weekly mixtape and weekend review. And if I'm being upfront, this is actually April 28th. I'm recording this on Sunday, getting this out a little bit later than usual. But yesterday, Saturday, I drove up to Chicago to participate in the Magnetar Capital stock trading event that they did with the University of Chicago. It was a great program. There were hundreds of high school students there doing a trading simulation. But that meant an early morning up, and then I came back the same day. And as you can see, I'm at home. Roman is upstairs getting Silas ready for church. My wife is actually moving her store from her old location to a new location today. So it's a little bit of craziness, and you get to come into my household today a little bit more than usual. But I want to make sure that we didn't miss a second week in a row of weekly mixtapes and weekend review videos. Last week was April. So hopefully this week's going to be real quick. I want to get into it real quick, and then get out so I can get on to my day, and you guys can get on to your day as well. We're going to start off with the headline game. And this time it's not stock market related. I actually have three headlines from the same week, making these stories kind of confusing for some of us sometimes. And again, just to highlight why we don't want to rely on headlines for any major financial decisions. But we're looking at real estate. So early in the week, we had U.S. existing home sales declined in March. Next, we have U.S. new home sales rose in March. So the key difference is existing versus new. But if you're reading this real quick, it might be confusing, mixed signals. One day it's up, one day it's down, which is the truth. And then home ownership rate drops for the first time in more than 2 years. So if existing home sales go down, but new homes go up, and new home ownership is going down for the first time in 2 years, what's the real state of the real estate market? To be honest with you, I don't know. I don't follow it that closely. It's one of the things I pay attention to because I have clients moving and just to have an idea of what's going on in the economy. But I don't read too much into the headlines month to month. But I just wanted to highlight those like I have in the past, with Monday being a negative headline for the market and Friday being a positive one. The same thing happens in different areas of the economy and the markets, and it makes it kind of confusing. So pay attention, but also don't make major decisions. Always consult your plan. Think long term. These are just momentary headlines, but they can be confusing. Like I said, new home, existing home. If you don't read it real closely, you might have mixed signals. All right, next up, the economy grew at 3.2% in the first quarter. So good economic growth in the U.S. So that's something we want to watch and pay attention to. And obviously we want to see that remain strong, if not get stronger. So that was a good reading, a good number, and that's a good thing to see. Stock related, I don't like to do individual stocks, but I thought this was an interesting story. So Uber, we know, is going to be having its IPO, and they actually lowered their target price. I think I touched on this last week that they were considering lowering their price, and then after what happened with Lyft did not have a very good IPO experience. So I think it's interesting what they're doing, and I think that part of what they're doing is trying to set themselves up to have a good IPO. But I also think there's a little bit of psychology in it. I believe they brought the price range down to like 40 to 50, bringing it closer to where Lyft, and I don't know where Lyft is exactly now, but I know it's got to be closer to that price. And I think the psychology behind that is investors in Lyft who believe in the ride sharing had a bad experience, and maybe now they can say, well, if Uber's the same price, maybe I think that's better. I'm going to jump from Lyft to Uber and hope I have a better experience. Not saying you should do that, and not saying that's exactly why they did that, but it is just interesting that they lowered it closer to the price range of where Lyft is, I believe. I forgot to look at it beforehand, but it's close enough, and I think that there's a little bit of behavioral reasonings behind that. And then finally, there's an article, there's a new regulation that's being pushed around called Reg BI, Best Interest, and this ties into the whole fiduciary versus suitability conversation we've had in the past. But real quick, if you don't know that, a fiduciary is a financial advisor who has to put their client's interest first. A advisor who's under the suitability standard doesn't necessarily mean they don't do that, but they're not held to that standard. So they can basically make any recommendation, put clients in products that may not be best for the client, and usually that comes down to a confliction when it comes to compensation. Two investment options, one is cheaper, one is better for the client because it's lower expense. Option B, option 2 is a little bit more expensive to the client, but it pays the advisor more. The advisor may choose option 2 because the investment components are the same, but they get paid more money. So that's the suitability. They wouldn't get in trouble for doing that. On the fiduciary side, a fiduciary advisor would get in trouble for that, and there's consequences. So anyways, they're trying to, and they being government and SEC and the regulators, trying to make a in-between fiduciary and suitability standard. So they come with this best interest, which means an advisor has to do what's in a client's best interest. And it's still very vague as far as if it's in their best interest. So I don't think it's a good fix, but it's being pushed around. And the SEC regulator says that it does not raise the bar over the suitability rule, basically saying it's not any better than it was the suitability standard. It's not an improvement, it's just a change of language. So this is important just to continue to spread the word about the different standards that advisors are held up to. And I've talked about this before. My firm is a fiduciary. I set that up for reasons that align with my beliefs. And one of the other reasons, to be honest with you, is the suitability rule. You're with a broker dealer, and I didn't need a broker dealer when I set up the firm. Now, that's not to say that down the road, if selling term life insurance becomes important for my clients and not referring it out like I do today, if I brought that back in, I'd no longer be under the fiduciary standard. Doesn't mean I'd be doing a bad job. So I'm not the one who's going to say fiduciary is the only way to be a good advisor. I do think that there are more conflicts on the other side. But I came from the other side, and I did a good job for my clients. I took care of them, always put them first. So there are good advisors out there. I think there's just more conflicts there. And the fiduciary side is not without its own conflicts. There's no perfect answer. So I just say that because a lot of the times advisors fight over this, and it becomes pretty ugly. And that's not what I'm trying to do. I'm trying to inform you, the non-advisor, about the different cares of standards of care that advisors are held to, and what that means to you and your relationship, and how they're compensated, and what are their incentives. So just be aware that there's this new best interest, but from my standpoint, I don't really think it's much better than the suitability rule. And the bad thing about all this, it's the dollars that are controlling it. It's the lobbying and fundraising. There's charts out there that shows you which politicians received how much money from the different investment companies that may be impacted by a change away from suitability to fiduciary. It's all very interesting, but we know that's how things work in America. So anyways, not to go down that rabbit hole. But that's everything. I ran a little bit longer than I thought to. I thank you all for watching. If you're listening to this on your Amazon device, thanks for listening. We will see you all in the next week. Be sure to check the mixtape articles below. They're real good. I put those out early, but I'm going to throw this video up now real quick, and then also get this over on the Amazon devices in case you're checking this a little bit later in the morning. So thanks for watching. We'll see you in the next episode.